Hello, everybody. Thank you very much for joining us. Some of you once again, some of you for the first time, but I'm super excited to welcome back Vouch. It's been a little bit since we've done an event with Vouch. This is our fault. We're busy. We're doing crazy things, but we will get more of these. Chris and Sebastian, you'll see more of their faces and other people of the team in the coming months. But today's event is all about protecting the cool thing that you're making. So as you run a startup, you're wearing all the hats, things are crazy. But as you start to make some progress, you'll want to be sure that you can actually protect that progress, because damn, is it hard to make progress in a startup. So once you get a little bit of captured value, you really want to be sure that it can't just go poof by the silliest little thing. One of the best ways you can do that is through insurance. And a lot of people don't really think about startup insurance all that often. They think like, insurance is the thing that like I'm forced to have, right? When I'm a big company, when I have, these like big plans and I just pay premiums, and it's like, it's the tax of success or something like that. But in reality, well, maybe that was actually true a decade ago. There has been some changes, Vouch being one of the leaders of those changes in the space, where insurance can actually be broken down in much more compartmentalized ways to fit companies at earlier stages than most usually thought. I run a tech company for almost a decade. When I wandered in, there was already insurance policies that were like, why do we have this? It's like, because 5 years ago, we had to talk to like some vendor. We worked with a government agency and they required this. So we went out and we went to this like, we filled out a PDF and it was confusing as all heck in the questions that they asked, but now we pay this much money every month because we have to. It's like, okay, we keep doing that. But earlier on, there's a lot more reasonable ways and rational ways and actually like good idea ways to protect your company as you make little bits of progress. And I'm not the expert in that, but Sebastian and Chris are. So they're both from Vouch, and they're going to walk us through kind of a 101 on what are the insurance needs and considerations you should make as you kind of walk along your startup journey. And don't be too scared, because you can actually cover a heck of a lot of what you care about for not a lot of money, and give yourself the peace of mind that if some weird thing happens, you're not going to just have to close up shop because you weren't covered by anything like that. As always, we're recording this. As always, I'm not a lawyer or an insurance person. Nothing is legal advice here, nor is it I don't know what you call it in your industry, but like a recommendation or anything like that. This is purely informational. We'll distribute out the recording and the slides after this, and we'll have some time for Q&A at the end. I'll be watching chat as well as the Q&A. If there's anything relevant, I would happily interrupt Sebastian and Chris with the relevant questions. So lay them at us and feel free. I'll make sure the chat's open. If you want to throw your startup name, where you're coming from, we'll get to see where everybody's at. There we go. Chat should be open now. So I'm going to hand this over to Sebastian. Take us away, Sebastian.
Thanks a lot, Nash. Great being with everyone again. I'm really excited to chat with you guys about a pretty important topic, at least in our world, and hopefully your worlds too, which is protecting your business through and whether insurance is the right way to do that for you. So I'm Sebastian Chen-Schmidt. I am a part of the partnerships team here at Vouch, and I have my colleague Chris Maggio, who's our expert startup insurance advisor. So he deals with startups and their insurance programs every day and is providing a ton of expert advice. And he'll go through a lot of the actual insurance coverages that might be relevant to you throughout your journey. So at Vouch, we think about risk a couple of different ways. And the way that we want to think about it is by the frequency and the severity of the risk type. And you can either, on the low frequency and low severity side, accept the risk, just see it as a cost of doing business. And if it comes up and we'll deal with it. You can choose to mitigate it. That might be something like implementing some protocols. As the frequency increases and the severity increases, you could choose to avoid it entirely. Maybe you don't do business in a certain area. You don't allow a certain type of use case. But if the frequency is low and the severity is high and you need to do it, you may transfer that risk. And that's what buying insurance would be. Putting the risk towards somebody else and paying a premium to do so. So let's look at an example of cyber insurance. If cyber is your biggest risk, you may choose to accept it and just hope you don't get hacked. There's no issues that come up, and many people will fall into that category, but some will not. You can mitigate it by implementing cybersecurity protocols or signing up with additional vendors to help protect yourself from those outside risks. You could avoid it and not operate digitally. I think many of the companies will not have that choice that we were chatting with today. And given that, you may want to choose for those higher severity incidents to think about transferring that risk through buying cyber insurance. So we would typically advise our clients to think about risk on an ongoing basis. This isn't something that you ask Chris about once a year and then you never think about it again. You are sure to face issues if that's the way that you approach any risks. But we want to think about it in terms of prioritization, identifying the risk and then prioritizing, choosing one of those actions we just discussed, and then monitoring it on an ongoing basis. And that will help to make sure that Chris and you don't have to have conversations too often, but that you're chatting as often as really is needed. So who thinks about buying business insurance? We saw it. Basically, nobody does at the first time that they found a company. Almost nobody. And for experienced founders, the second time around, 2/3 of founders buy insurance at incorporation. And essentially, it means that those founders that have been around the block realize how much things can go wrong and choose to help protect themselves from like a really bad case scenario. Nash just said it. It's really difficult to get traction in your business, and you don't want to get derailed by an angry first employee that you're the first person you ever fired to get angry and sue you, take up all of your headspace, take up all of your runway in something that really doesn't move the business forward. So what does it cost? Here we've just put together a little quick view. And as Nash said, none of this is specific, and please don't quote this in the future, but just to give you a little bit of an idea for scale, at formation, that first policy is going to be a few $100 a year. It's going to, have kind of some general liability requirements, maybe business property, a couple other elements that Chris will go into. But as you start scaling, perhaps you get a contract requirement, or you're signing a lease or raising a round. And some of those types of events will necessitate a different type of insurance, or at least help you think about what types of insurance should be relevant at those times. And the price will increase with that. So just want to give a little bit of an insight into what the typical scale of cost is for startups of different sizes. Here's the legal disclaimer that Nash and I are trying to get out there. But basically, insurance it's rarely very black and white. There's a lot of gray in between. And at Vouch, we really try and side on the side of our clients and be there for them in times of claim. So if there's any way that we can accept a claim and it's legally permissible for us to, we'll do it. Great. And I'm going to hand it over to Chris to start, talking a little bit more specifics for you about the types of insurance that might be relevant for you.
Awesome. Thanks so much, Sebastian. Nice to be with you all today. As Sebastian mentioned, I'm Chris. I'm one of the insurance advisors here on the early stage team for Vouch. So early stage startups is the only group of people that I talk to all day, every day, and really enjoy this space. So we'll get into it here. This being the first bucket. So let's say you guys are newly incorporated. There's going to be some basic coverages that a lot of people have or are going to want to start at least thinking about if it doesn't become a contractual requirement at this point. The main coverages that we're going to discuss in this incorporation section are going to be very basic foundational coverages, those being general liability and business personal property. And we're good to go to the next one real quick. Awesome. So as I mentioned, this is general liability. My typical trigger for recommending this to startups is if you have a physical office space that you're renting, owning, leasing, instances like that. This being designed to protect you from trip and fall situations. Somebody puts a hole in a wall, gets a little too rambunctious at a company event, instances along those lines here. Now, this also kind of depends on your niche or your operations, what you guys are doing specifically. So if you're in a hardware space where you're actually manufacturing a product or you're selling a physical product to folks, this is really going to be important. And it's going to be important to check that you have product liability added on under your general liability coverage as well there. Just designed to protect you in the event that your product services causes harm to somebody else, right? Now, if you're a SaaS B2B company, this is probably going to be a little bit more of a scaled back risk for you, especially if you're operating from a remote first perspective. Not going to be too top of mind, but something that I think is a great foundational, again, like basic policy to get you in the door, allow your company to kind of grow your insurance package from there. A lot of the times, as the slide says, it will be required by landlords, banks, and then you'll run into this for enterprise customer contract requirements as well. Getting back to what Nash said, kind of just like, hey, they used to require this 5 years ago when everyone was working in offices, still typically going to require it as a boilerplate contract requirement. Now, typical costs, if you're in the section the category of like, hey, more scaled back risk, B2B SaaS company operating from your home. This is going to be on the lower price spectrum, typically around $200, $300 annually. Now, if you are all working out of an office space, or you're actually physically manufacturing products, or you have physical products that you're selling, going to be a little bit of a higher risk, therefore a little bit of a higher premium there as well. I think we can go ahead to the next slide. These are going to be some of the similar like claims that we run into, claims that you're going to commonly encounter that are designed to be picked up by the general liability coverage. So one of them that I alluded to earlier, like a slip and fall, this being for, it's important to note here, this being for third party people, not you or your own employees. So this is if a guest comes in to an office party, or the mailman's delivering some mail, maybe they slip and fall. This then being designed to come in, pay for any legal defense fees if it gets to that point, medical expenses as well for that injured third party. And then maybe you are in the space where you're actually producing a physical product, selling that to people. You want to make sure that you're protected if your product that you're selling causes somebody else injury. That's where we look to this device malfunction potentially. So say you have a smart home device even that you're putting into people's homes that catches on fire. That's where you're going to want to make sure that you have the product and completed operations portion of general liability, so that can kick in, defend against lawsuits, and then compensate those affected third parties if the product that you're selling, manufacturing, actually caused any sort of physical damage. All right, in business property now, this one actually typically looped in with general liability as well. This being designed to protect the business property that the business owns, right? So in a lot of cases nowadays, think employee-owned laptops, company phones that are furnished, desks, instances like that. Let's say you spill a cup of coffee on a laptop and it's ruined, you need that. That's where this is designed to kind of come into play. Again, it kind of depends cost-wise what you're protecting. If you're protecting a lot of valuable lab equipment, let's say you have hundreds of thousands of dollars of lab equipment that you're using in your operations, that then probably going to cost you a little bit more, going to add to the cost of the general liability in total there. Now, let's say it's just you're working from your laptop, again, more scaled back risk, typically a lower premium there. This one, I really recommend again as something that you should keep in mind right away after incorporation if you do have a lot of physical, expensive equipment to actually protect. Again, if it's just you and your laptop, probably a more scaled back risk, not something that you need to worry about too much right now, but could be nice to have. And then these claim scenarios, so something that we've kind of already alluded to. So stolen goods, maybe you're working out of a co-working space, you leave it to go to the bathroom really quickly. All of a sudden you come back from the bathroom, you realize your laptop's not there. You need that, it's essential to your business operations. That's where this business property coverage is designed to kick into place, pay to help you replace that stolen laptop. Now I kind of put this fun one in here too. Maybe there's a storm, lightning strikes the building at the rented office space that you guys are working out of. That causes this power surge. It's going to damage all your servers and electronic equipment. That then also designed to kick in this business property coverage, cover the cost of repairing or replacing that damaged equipment. So goods don't necessarily have to be stolen or coffee spilled on them. It could come from an inclement weather event as well there. All right. So now we're getting to the point where, hey, maybe it's not just you anymore. You're growing your team a little bit more. You're starting to hire people, whether that be W-2 employees or 1099. There's going to be a few coverages that you're really going to want to keep in mind. Workers' compensation being one. Now, I did talk earlier on general liability, that being for third party. If not you or your people get hurt, this is where that workers' compensation comes into play if you or your people do get hurt during work. And then employment practices liability as well. This really, we'll touch on it a little bit more, but going to be a big hitter, especially in highly litigious states such as California and New York. We see this claim a lot more. As we put on the slide here, it's 6 times more likely than a cyber loss nowadays. This is something that's just consistently getting more frequent and more expensive. Once you get to a point where you have 3 full-time employees or more, I recommend it after 1 in New York and California. That's when you're really going to want to start checking your boxes, making sure that you have a good workers' compensation in place and the employment practices liability as well.
I want to chime in a little bit here too, because I see this
Please.
a lot with first time founders where the idea of hiring and firing seems like a luxury. Like, oh man, if I could hire, people and control my team, like that means I'm making success. But oftentimes, especially first time founders, I don't think they anticipate sometimes how many firing conversations you might have, because the life of a startup is, a lot of people say they want to get into it, but they don't. Like, it's, early employees and whatnot, they might come from a background of expecting working for a large corporation, having HR and benefits and all those kind of things. And they get into the deep end and they're like, oh, I don't like this. You're going to have to handle that as the founder CEO. You're not going to have, if you're a 5-person company, you're not going to have an HR team that you're going to go to. You might have a PEO that can go and talk to someone, but it is not going to resolve the situation at work. So one, getting good at handling that and expecting it. But churn is much more common in startups as you really try to find those good fits. So you might find yourself in a position where you're handling delicate matters and dismissing people in ways that you might not have the HR army to lean on, in terms of covering all the bases. So making sure that your base is covered from an insurance standpoint, should somebody, not see eye to eye in the event of an exit, can be a big help.
Exactly. No, everyone's best friends until they're not. It's something we run into a lot. So couldn't agree more, Nash. All right. So touching on workers' compensation side, so this being designed to protect you and your employees in the event of an accident or illness on the job. This again could be like a trip and fall situation. This could be something that kind of builds up over time and then ends up injuring or contributing to the injury of an employee, yourself there. Now, why does it matter? It is required in all 50 states. What you'll notice, depending on where you're operating out of, is that sometimes a state makes you get it through the state fund. Washington being that, for example. In other instances, back to the PEO subject, I typically do recommend trying to secure this through your PEO or payroll provider, just for the sole fact that it makes it a little bit easier on you, the founder, administratively, not having to manage adding people, removing people, keeping track of salaries, keeping track of home addresses if you are working remote first, etc. Now, the key trend that we have seen here, I'm a remote first employee. It's not uncommon nowadays for a lot of people to be in that remote first kind of world and setup. Workers' compensation still does apply to those remote employees. You just need to make sure that you have their proper home address, their information as well for those workers' compensation applications. A lot of premium here being based off of location, and then also going to typically be based off of that person's salary, your payroll there. Now, again, depending on the states that your remote employees are working out of, they may be able to kind of just secure this through the PEO as well, get added there, or you may have some additional legwork on the back end there going through the actual state to secure that workers' compensation as well.
We have a relevant question from Ryan Yoshimoto, which I know this plays out in everybody's head. So remote employees, you work out of your home, maybe you have a corporate laptop, but how does workers' comp actually work? Like, if I'm on the second floor right now, I have steep stairs. If I take a break and I go downstairs to get, a cup of coffee and I fall down my own stairs, I'm in the middle of the day. Is that a workers' comp claim, or like, how does that actually work? I'm not in an office. I'm not, falling down the office stairs or tripping on cords with cables or anything like that. What does that actually look like?
Yeah, it's a great question, Ryan. And I think it could get a little hairy, just to be honest with you, like how this is settled and what that looks like. Technically, if you're in the course of work, you're performing your job like you're supposed to be, you're at the location that you've said you're going to be at, instances like that, it is designed to technically like kind of kick in and pick up that injury. I think a lot of things we see nowadays is more so along the lines of like a injury coming after a longer period of time. So like somebody developing like carpal tunnel syndrome because they've been typing a bunch.
Right.
Maybe you say you have eye strain because you stare in your loft at your computer screen all day. I think we see a lot of those instances. I too would be curious to see what it looks like if you were to say, hey, I'm taking a break, and then you trip down your stairs. I think the break portion of that statement might kind of bite you. We'll see. Yeah, and this is getting into it. So if you are in an office space, it does make this a little bit easier, I think, from like a claim settlement standpoint. You're in the office space, trip and fall, there's some sort of traumatic injury that occurs from that. Workers' compensation may kick in to defend there or pay for those medical damages fees as well. And then, like we talked about, a lot of the times just working in tech industries, more so repetitive stress injuries, eye damage, eye strain, back injuries from that, carpal tunnel syndrome, etc. I think this also becomes a lot more expensive and more relevant again if you are manufacturing products, instances like that. So again, if there's a physical product, you have people at a manufacturing site manufacturing products, maybe they clamp a finger, something like that. That's also where this workers' compensation is designed to come into play. Like, all right, the big hitter. So employment practices liability, really designed to protect your company in the event of like a wrongful firing, hiring, those wrongful termination suits, or alleged discrimination, harassment. This then being designed to pay for the legal fees, settlement fees, fines, judgments, etc. Um, it's a crazy figure, but it does matter because 40% of companies at some point do get sued by an employee. The average cost typically about 125 to $200,000 when you actually add up the defense fees for that, and then also the settlements for settling these. So we do recommend it, especially if you have 5+ employees. I'm trying to take a more proactive step now with my recommendations and recommending it after your third full-time hire. And then, like we talked about, first employee in California and New York, just because of the laws that they have there kind of favoring the employee side of things. Really important to be aware of this and have this in place within that 1 to 3 employee kind of range. Like we said, the key trend here is that we just see this a lot more. This is the most common claim that we deal with on a daily basis at Vouch. This is a common claim scenario that a lot of insurance companies deal with. For that reason, you are seeing, and we're seeing, some increased pricing around employment practices liability, more claims, more frequent claims, more severe claims, typically, unfortunately, kind of lends itself to increased insurance prices as well for that specific coverage. But this is hugely important if you're operating with anybody once you start getting those 1099 contractors even, or the W-2 employees.
Hey, Chris, real quick
Yeah.
before we
Oh, please.
move on, I think we had a question, just another one about workers' comp that might be relevant to answer before we kind of move on from the section.
Oh, I'm sorry. Yeah.
No, no worries. So they were asking about 1099 contractors. James Deere asked about 1099 contractors and if they require workers' comp. Do you know?
Yeah, it's a great question. It actually, I believe, has to do with the specific state that they're working out of. Certain states are going to have different definitions for employees, and how they're defined by the particular state, I believe, is whether or not they need to be included in workers' compensation. So I guess it's a kind of a tricky answer. I would check with your state and kind of just do a quick Google search, like, hey, are 1099s required in Virginia, like, to be added to workers' compensation? That's something where I think it's really helpful, again, just to kind of like lean on your PEO a little bit too, and see what those specific state requirements are for 1099, how they're defined and categorized, and whether or not they're required to be added to the workers' comp. Is, I guess, my broad answer there.
I think there's a good example here because for the longest time, it was like 1099 contractors, they're doing their own thing. The whole reason a company
Yeah.
would hire them. But as of late, California is always the great example of the state that just keeps making laws and regulations. And this is something we get into a lot, is when we tell most founders, if you're a founder of a startup, you, in the beginning, you're generally not an employee. You don't have an employment agreement. You're not paying yourself a salary. There's no workers' comp. You're not working with a PEO. It would be a bunch of money for no reason, right? You're working for free. You're trying to get things off the ground. You're a founder. You're often a director of the company, you know, probably not the officers of the company. And you should have an IP assignment with the company so that the company owns what you're producing, but you haven't really hired yourself in that way. So we generally say founders aren't employees unless you happen to live in California, because California has a couple laws that basically say, like, oh no, if you're working for an entity, you are technically an employee and you're guaranteed a certain amount of minimal rights. And one of those is being paid minimum wage. And so it's like, are you going to pay yourself minimum wage? Like, if you're a sole founder and you're putting your own money into the company and then paying yourself out, like, it's often not anything you're going to think about. But who would make a big deal out of that? It's not like California is going to come to your house and be like, we must enforce this. Start paying yourself $15 an hour. They won't even know. You're not going to sue yourself to be like, hey, I deserved the minimum wage for my own thing. So a lot of times it's a non-issue if you found a company and you do that, or even two co-founders, right? You both agree, you build a company, later on things go well, you hire people, you start complying with those laws and you hire employees and things are cool. But it is worth knowing the state you're operating out of, because in some cases, say you have three co-founders, two stick it out and one leaves after 2 years, spitefully or whatnot, they might have a case where they could come back to you and sue you and say, hey, I deserve minimum wage for those 2 years I put into that because California law, blah, blah, blah. So it's good to be aware of what your state requirements are, knowing that one, the state's not going to come in and like knock down your door and be like, you should be obeying these, but it's all about protecting yourself from potential cases that could be made. And I'm sure the same thing goes with 1099.
Exactly. And then, I mean, to that point too, like fines, New York likes to throw them out pretty quickly. If you're not compliant with workers' comp. So again, just goes back to like knowing your state, depending on your specific state. I'm happy to kind of discuss that further offline. Right. So these are claims, and then potential resolutions for the claims. So wrongful termination being a big one. Maybe somebody's alleging gender bias, instances like that. Maybe that's why somebody is claiming that they've been fired. Maybe somebody's getting back from parental leave and it just so happens that you're going to terminate them. Those can be really sticky, hairy situations. And that's why it's important to protect your company's future and bankroll by having something like employment practices liability, because it then is designed to come into play to pay for the attorney fees to defend against that kind of claim. And then if there is a settlement, to pay for the settlement as well there to that individual that's claiming to be wrongfully terminated. Alleged discrimination based on disability is another one that we see a lot of the times. Maybe there's retaliation based on that disability, again, designed to come in, defend in that sort of lawsuit scenario, pay for the attorney's fees as well as any settlements that may occur. So these can, again, like we saw in the $125K to $200,000 range. This is why I think insurance is great, is that you can offload that risk, make somebody else pay the $200,000 rather than accepting it yourself and kind of being on the hook to pay for those attorneys to settle this fee, or pay the fines and settlements. All right. So customers. So at this point, we've kind of discussed some relevant coverages once you're incorporated, just getting your boots going, boots off the ground, getting that started, and then hiring employees, hiring first employees. Now we're going to kind of dive into some important coverages, coverage recommendations that I make. The main trigger being that you now have active paying clients relying on your product or services. We're going to kind of go through all of these obligations as well, and then touch on those important coverages that we listed. So the first one being errors and omissions coverage. So really designed to protect your company in an instance where your services or product causes a financial loss to a client. But we can think of this as a little bit more broad than that, even as this being triggered by instances even of like misstatement, misrepresentation, negligence. A big one that we run into a lot of times is product failure. That's where this is designed to come into play if you're found liable, to protect you, pay for those legal defense fees, settlement fees, fines, judgments, etc. Why does it matter? It is typically going to be a contractual requirement that you run into with larger enterprise customers, clients. This one being more relevant to a lot of people's actual operations. And then it's also important because it can be pretty costly. If you say your product's going to work a certain way and it turns out that it doesn't, and people start wrapping you into lawsuits because of that. It is going to be a high variance in cost, just depending on your sector. So depending on the space that you're in, operationally, if you're a fintech kind of company, probably going to be a little pricier. It's highly regulated. Instances like that is going to kind of offset and impact the pricing here on the errors and omissions side of things. All right. And then we'll get into cyber before kind of jumping into some claim scenarios. These two, why we did it this way is because they complement each other a lot of the time. Cyber and errors and omissions are things that I'm always going to recommend you bundle together. Again, depending on your operations, a lot of the emerging tech companies that we work with, this is my typical recommendation, is to bundle those two. Cyber really being designed to protect your company in the event of a data breach. And you can think of this as being two-sided. So first-party cyber paying for your system. So software remediation that you have to do on the back end, any investigation costs to kind of figure out why that breach occurred, where it came from, etc. Cost of notifying clients in the event of a breach, PR-related costs, etc. Then third-party cyber coverage. Let's say that you get wrapped into a lawsuit that's stemming from that data breach. That then being designed to protect you and provide payment for legal defense fees, settlement fees, fines, judgments that may occur. It is typically required by customers. A good chunk of small businesses still have reported a cyber breach. Maybe they just don't have the right MFA in place, things like that. It's just getting tough to kind of protect yourself. I think a lot of early stage startups kind of think like, hey, we wouldn't be a target for anybody. Why would anybody want to hack our system or hold us for ransom? That's why you want the cyber insurance, so that you're not having to pay that out in the event of like a ransomware attack, or that if some sensitive data is compromised, that you can let your customers know that it's paid for. You can have some PR remediation from us as well there, and then also kind of software remediation to make sure that it doesn't happen again. Now, a lot of people do use, I think I saw earlier in the
I was going to say
conversation.
Steve's question about using
Yeah,
AWS or Google Cloud or whatnot. Does that
exactly.
make you less exposed?
I think it does make you less exposed. I think it's a good best practice to kind of offload it there. However, I think in that sort of situation, my call out would be like a business interruption case, right? So maybe AWS goes down, it'd be crazy. Like something happens on that side of things, you're no longer able to operate because of that outage or that breach. That's where the cyber coverage can come into play as well, and kind of just pay to keep you up and running while that breach is remediated. Now, that's like saying if AWS goes down and it impacts your business. Now, let's say if your business gets impacted and that then trickles over and impacts AWS, right? This then also designed to kind of pay for those fees if there's legal defense fees, settlement fees, fines, judgments, etc., that stem from that leakage. But then also designed to pay for some of their business interruption costs as well if their system's impacted. Can kind of go both ways there. So I do think it's a good best practice. That's what a lot of people do for data storage nowadays. But I think a business interruption kind of claim is more relevant given that situation.
Yeah, and I think also I know this from personal experience in my engineering background and way too many interesting cyber cases, but using well-known cloud providers like AWS and Google protect you from a certain degree of cyber attacks. And most of that is security patches are up to date, backdoors, really technical stuff that would be like, it would be a lot for a startup to really understand and keep up to date with all the CVEs that come out when they identify node bugs and daisy. You don't even want to be in the business of tracking unless that's what your startup does. However, you can run a server on AWS, and what that server does, if somebody calls your secretary or your customer service person and like social engineers their password out of them and then breaks into that AWS server and downloads all your data, AWS has not helped you at all in that. Just because they have great security principles, like that's still a cyber attack in a way. Or like if you get a DDoS attack, we got DDoSed in June, and it's like no amount of cool cloud provider is going to stop, a Russian bot farm from just hammering your site like crazy, even though your AWS servers are just sitting there being like, oh, they can't exploit anything. They're not taking any of your data away, but they can just overwhelm your infrastructure. And you're still, if you lose money, you have an outage, customers can't buy things, customers get angry because, if you have mission critical solutions, depending on what you're doing, you're still vulnerable. And honestly, I think most people get cyber too late. I think most people get cyber when a vendor forces them to do so, rather than proactively. But I think you can probably, ours isn't even that much, but I rest more comfortably knowing that like if, there's kind of a probability roll of the dice. If somebody is really a maliciously bad actor and wants to go out for you, like they can probably figure out a way to do damage. And that might not be irreparable damage, but it might waste a couple of days of your time, or at worst, a reputational damage, even if nothing is actually leaked, but the attack does, suck for you and your team and your reputation.
Exactly. No, Sebastian, anything to add to that? I couldn't agree more, Ryan.
Oh, and Steve asked that question. I believe he asked, can he do a 15-minute discussion with you guys to review his scenario? I think you guys offer that, right? Isn't that your front door, basically?
Yeah, so certainly. I guess you can go to the Vouch website. I think Sebastian has a neat little plug at the end here, kind of about that. But we're more than happy. I think you can fill out like a call request form, and we can kind of get that 15-minute conversation rolling.
I think we have a nice little co-branded site somewhere that I will
We
try to
do
find
too.
and put in the chat.
I've just
Yes.
posted it in the chat too.
Oh, look at you. Fantastic.
Awesome. Fantastic. So these being some claims that come up, some that we've run into before and that aren't uncommon as they relate to cyber and then errors and emissions as well. So the hacker side of things that we've kind of talked about, maybe there's a data breach, somebody gains access to some unauthorized customer data. They compromise the sensitive personal information of those people, addresses, payment information, phone numbers, etc. It's going to step in to cover a few different things here in that sort of situation or similar situation. So costs associated with notifying this client, the affected clients, credit monitoring services, if you had to enact that, hiring experts to investigate that breach, and then implementing new security measures, any sort of remediations you have to do on the back end there. And additionally, helping manage some reputational damage costs that may ensue from that. You don't want your reputation damaged. It's something that you've worked so hard to build up. This helping at least pay for some of those PR costs to kind of give people their trust back in you. And then if a lawsuit still follows from that breach after everything you've already done, those defense fees, attorney fees, etc. as well. Now, let's say on an E&O claim that your startup offering a live concert streaming services for a fee, and you have a bug that's gone unnoticed, and it causes a live stream of the concert to crash, right? As a result, your paying customers are upset with you, and the band that you're supposed to be broadcasting, that musical group that enlisted your help, is also upset with you. That's where it's going to come into play again, kind of picking up those legal defense fees, any additional fines or judgments that you may incur based on your product failure to perform your services, your product's failure to perform its services as advertised is really where that errors and emissions coverage is going to be important. Right. Great. So we just wanted to kind of touch on this more briefly. Some other common coverages that you'll want to start considering in addition to the main, I guess I would call them like core coverages that we've discussed today. And then again, depending on what stage you're at or your company is currently doing. So directors and officers coverage, really important is if you've raised some capital, if you expect to be raising capital in the near future, and then it becomes a requirement for your Series A round there as well. Think of directors and officers as like the bag of money that's protecting your executives while they're just doing their day-to-day jobs, making decisions on behalf of the company in the event that somebody tries to sue them for the decisions that they're making. So it's protecting your home, your personal assets, your personal savings account, but then also protecting your actual business, the capital that you've raised to date, the money's there as well. So again, it's really important if you're expecting to raise capital, can make you a more attractive investment opportunity for future investors, or if you've already raised capital, not only to protect that capital, but to also help you raise more. That's where the directors and officers coverage is going to become really important, something to keep in mind. So crime coverage, that is actually in the event that there's like a bad actor. Let's say that they're taking like monies, stealing monies, personal information, things like that. That's where it's going to be really important. I typically recommend crime if you have somebody that has access to like client credit cards information, for example. If you have somebody that has access to that, maybe they were a remote employee, maybe you're a little worried about them becoming a bad actor at a certain point. That's where the crime coverage is going to come into play. Theft, forgery, fraud are the big things that we're going to see related to the crime coverage. So something to keep in mind there, depending on who you have watching what, who has access to what sort of information that could be exploited. Now, these being a little more scaled back, hired a non-owned auto. If you have, let's say, for example, like an outside sales team that does a lot of house calls, they're driving their personal vehicle to get them to those calls. So it's technically being used in the course of business. That's where this is coming into play, going to pick up in the event of like a car accident. Or maybe you travel frequently, you're going to trade shows a lot. you're renting cars constantly. Again, hired and non-owned auto. If you're using that vehicle in the course of business, important to protect you in the event of a car accident, picking up the property damage, but then also liability side of things there too. Now, fiduciary, this is going to come into play more so once your company is a little more mature. Also, once you start offering employee benefit plans, think of like a 401k, IRAs, things like that. If you're actually managing financial assets for your employees, that's where this is going to come into play. Just so maybe somebody gives some poor investment advice, something along those lines. That's where this fiduciary coverage is going to be important. And then again, employee benefits liability, typically recommend getting both of these at a similar time. If there's any misadministration in the benefit plans to your employees, maybe you thought you signed Joe up and you didn't actually sign Joe up, and Joe thought he had a certain health plan or he had a 401k that he was vesting. Turns out he didn't. That misadministration there is going to be important on the employee benefits liability side. And then media liability. Lastly, depending again on your operations, we typically add this to our errors and omissions coverage. This being if you guys are actually in the business of creating content and distributing that. So think like blog posts, email blasts, even instances there. If somebody claims any sort of like IP infringement, is where the media liability coverage is going to be important as well in protecting your company. Awesome. Yeah, and then back over to Sebastian now.
Yeah, so we kind of did mention a couple of these resources throughout the presentation. I think they're linked in the chat here, but the best way to start the conversation with Chris or any of the rest of our team is through that Vouch and Gust landing page. That's right here. We also have a blog that goes into a lot of specifics around different types of insurance, and we produce a lot of relevant content. So that's linked in the presentation here as well. And then we have some additional resources that once we send the slide deck out, you should be able to click these links. And generally, the insurance milestones guide goes to basically pinpoint the stage of journey that you're at in your startup, and will pinpoint what coverages are maybe relevant to you throughout that time. And you can take a little bit of a deeper dive in there. And we do go through a little bit more specifics around cyber and E&O and a couple of other overview documents. So we'll again pass this along within the presentation when we circle back with that. I think we've had a couple more questions in the chat, so if maybe we want to tackle a few of those. I think I'm just going to kind of go through in order of when we receive them. I have answered a number of them in the chat, so if you haven't checked whether your question's already been answered, you may want to look there. I may have typed it out. I think the first question is about personal property. Are in general, are floods typically included in your standard form, Chris?
Floods, I think so in the standard form there. I mean, I'm sorry, I was trying to read this on the homeowners. Yeah, so I guess this dives into kind of like the difference between your business property and just your stuff, right? So if it's not like company owned or helping you in the course of business is where that can get a little bit tricky. It is my understanding that something like an earthquake is typically excluded with business property. However, in instance of a flood, lightning, thunderstorm, heavy rains, those are typically included and picked up for business personal property coverage.
Yeah, as somebody who lives on the shore, I feel you, Jeff. I have to have flood insurance because I'm in an AE flood zone, but it is very separate from my homeowner's insurance. But I do think it is a little different when it comes to business. But what a racket flood insurance is if you live near the water.
Oh, yeah. All right. Healthcare related. What's that?
Yeah, we had a number of questions about healthcare. How does it, I guess, really just high level, how does healthcare change the game, insurance?
Does healthcare change the game?
Like, our healthcare covers company? Do they need to consider something different than Vouch? Is there like a whole different realm of insurance to consider if you're a healthcare or medical devices company?
Okay, gotcha. Sorry about that. So health life sciences space is a core vertical that we do serve. It depends on what you're doing. So if you're actually like a practitioner with a doctor's office or dentist's office, instances like that, not going to be Vouch's realm. per se. So, however, medical devices, manufacturing of those, sale of those can be within appetite. I kind of always just recommend filling out the vouch application. It takes about 10 minutes to see if we may be a good fit for your products. It depends on kind of what those medical devices are intended for or what they're doing. Now, if you're in the telehealth space, I'd say that fits really well with the services that we offer. We do have an exclusive digital health endorsement, actually, that's unique to Vouch, where we're then adding bodily injury and personal injury coverage to our errors and emissions and cyber policies. So that's really unique to us, can't be found elsewhere. So if you're giving out health advice, instances like that, maybe you're connecting to people's EHRs, maybe you're a company that helps make communication easier between like doctors and patients. Instances like that would fit really well with us. Now, health insurance, if you're thinking about like from that perspective of offering it to your employees, is not going to be Vouch. That's actually technically considered like a personal lines coverage and something that's shopped out completely different that we wouldn't have access to. All right. Do you offer customized plan forecasting?
Yeah, Dan has a great question in the Q&A.
Yeah.
Maybe I can take a stab at that one.
Yeah, go ahead.
Yeah, so I think that I think that 7 years down the road for pretty much any business, but I'm sure a startup in particular will be very difficult to be extremely accurate. I think they're going to be best guesses 7 years down the road. So I think if you can connect where the rest of your financial model is expected to be with some of those guidelines that we issued throughout the slides from today, then you can help piece together at least a little bit, a well-educated guess to where you'll be, years down the line and how much the insurance costs might be in those, with the pieces of insurance that might be related to your business at that stage of growth.
Yeah, I think one of my favorite things about Vouch is, I believe the slide was in the beginning of the presentation, but the timeline graph of like when to consider different policies, as you grow, and then adapting it to the industry you're in, might introduce some additional ones. But I think in my experience, that is the most, not the most, but it is one of the more valuable things that you offer, because previous insurance companies are like, fill out this random survey and we'll just like tell you what you need. And it doesn't really give you a roadmap. It just kind of gives you a transaction.
Yeah. Yeah.
I think you got a thumbs up from Dan. Dan's company is super cool, by the way. He is starting literally an airline. So it's going to be neat.
Very cool.
Hopefully Warren Buffett buys it down the line. He loves airlines. So.
I can. Related to the medical stuff, we had Kay earlier. She had a question about D&O, but I'm going to jump into manufacturing. So she's looking at using a co-manufacturing site for drugs, and they asked to maintain equipment insurance. How do they cover this equipment that will be used to manufacture clinical materials? Is it just the value of equipment, or is there like a larger coverage for equipment insurance?
Yeah, it's a great question. I believe a bulk of it's going to be based off of like the actual value of the equipment, and then location playing a factor in there as well. Something that we don't technically offer if for specific like equipment coverage through our proprietary products. I think another nice part about Vouch is that we do have full brokerage capabilities as well. So maybe a more common coverage in the traditional insurance space. But yeah, a lot of it based off of the value of the equipment itself, cost to replace it, kind of with like kind and quality equipment down the road too, if something were to happen to that equipment.
And Kay's other question is about D&O insurance. They've raised $2 million with a $7 million valuation. They've got 5 board members. Actually, fantastic, Kay. You have your the 5 board member outside independent. That's great. You're following our advice. What is the acceptable amount of coverage? Obviously, you can't give a prescription for her company in particular, but that's roughly, a pre-Series A-ish, healthy seed round company.
Yeah, absolutely. And what was the capital raised again, Ryan? I'm sorry.
2 million at a 7 million pre-money valuation. So a $9 million company effectively.
Yeah, that's fantastic. I think for the current capital raised, my typical recommendation, just based off of our benchmarking limits, would be a 1 million in D&O coverage. Once you get over the threshold of 5 million, my recommendation then jumps up again, and just kind of depending on how regulated the industry is that you're operating in, closer to a $2 to $3 million directors and officers policy. Someone pre-seed, I think the 1 million is a really good spot to start, especially since you've raised current capital. from there, really easy to kind of just upgrade your coverage limit since you already have the D&O in place from that 1 million kind of threshold.
Awesome. Keel's got a question. He's a SaaS company. They're holding client business information. So they're helping other businesses in their system, and they have the potential to hold PII, person identifiable information in the future. What should they consider in terms of how much coverage to get?
Yeah, great question there too. Cyber being the biggest call out here for protecting against instances of that business information or near future kind of that personal information as well. Good starting space if your pre-revenue is going to be about 1 million in coverage for the cyber there. That'd be my recommendation. Now, what's nice about the cyber is that you can do the first party and third party. What some people do if you're pre-revenue is you'll start with like a lower first party cyber coverage, say 500,000 for that, and then we'll bump up the third party to 1 million. So in insurance terms, basically, just not to try to get too technical, the aggregate then is $1 million. So you have $1 million to play with if anything happened. Once you get over a certain revenue threshold, I'd want to say like once you're producing over 1 million or kind of closer to that point in revenue is when my typical recommendation again jumps up to that like 2 to 3 million in cyber and errors and emissions coverage limit.
Sorry, Sebastian, I saw you answered that in the chat, but I was scrolled up and I didn't see it. Thanks for the extra context, Chris.
No, for sure.
Just a follow up to that, for you guys, how much would be 1 million in coverage for cyber? I think you had it on the slide roughly, but in premiums.
Oh, let's see, actually, real quick. We can give a minimum premium guess.
Yeah, it's always going to be caveated based on your business and the information you provide.
Exactly. Yep. Always caveated on that, kind of what that looks like. Let's see minimum premiums here. I want to say, yeah, our minimum premiums about $750 annually. I guess I wouldn't apply to Vouch thinking that you're going to get a quote and it's just going to say 750. Again, definitely depends on like your firmographics, what everything kind of looks like, maybe best practices or revenue that you already have in place. Yeah, but I'd say typically closer to like the 1,200 annually kind of range there, maybe.
Awesome. And Sebastian, I think you got Jeff's question about hardware, and I think we did cover that one too. Anything else? I think we're good. If you haven't gotten a question answered, feel free to just poke us. Oh, Rob, you did ask the question way up, and I'm sorry. That was the first question asked. He has $2 million in errors and emissions for a merchant credit card processor. Is that enough? I don't know if you can necessarily answer that.
But maybe around is my horrible, not like great answer.
I think a lot of this scales with kind of what we said at the beginning is like,
yeah, it's
how much are you protecting? Like if you are making, $20,000 a month off of a brand new startup, like, do you need millions of dollars of coverage for errors and emissions? Probably not.
Probably not.
If you are making millions of dollars a month, your calculus is going to change substantially.
Yeah, exactly. I mean, if you have 5 million in revenue as the card processor there, I mean, I'd recommend, I think you're in a good spot with the 2 million. Could go to 3 there. And then, yeah, cost wise, I kind of runs the gamut at that point. I mean, going to be heavily based off of current revenue, things like that. So if you're starting and you're getting a $2 million cyber policy and it's cheap now because you don't have any revenue, that can pretty drastically change. If all of a sudden you have a really fantastic year and revenues increase exponentially, you then have a lot more to protect. The premium's likely going to be a lot higher too.
Awesome. Well, I think we can wrap. I could use a break from talking today myself because there's been many events, but Sebastian and Chris, it's awesome having you back. Like I said at the beginning, we're going to try to get some of these more out, and we'll shape up some more specific ones rather than just going through the 101. We might have some kind of like specialist stuff because I know everybody always has a question. What about medical? What about, hard tech? What about this and that? So be on the lookout for more programming from us in the coming months to handle your insurance needs and all these interesting things. Thank you so much for the great questions and a lot of engagement. Check out Vouch. I'll post that link again if it's on my clipboard. Hopefully it is. They can help you out. You can chat with one of their advisors just to get a good read on this. It doesn't hurt just to have your roadmap in place. Even if your idea stage, you're just hacking in the garage, it's great to know like, oh, I remember after 3 months or after I do this thing or after I bring on my first team member, I should go do that thing. And that's why we like them. They're like us. A little bit of proactivity can really help change the game on the long term for your startup. So Chris and Sebastian, thank you so much.
Pleasure. Thank you guys.
Have a
Great
great one,
meeting all
everybody.
of you.
Bye.